Thank you very much, Lassen. I'm delighted to be here to make this presentation today. I'd like to thank the Carnegie Middle East Center and Paul Salem and Lassen Ashi for hosting me and us. I'd like to thank Nadim Hasbani and Cynthia Ohayon for having organized this session. It's my pleasure to make this first presentation here after having presented the Regional Economic Outlook at the Banque du Liban last week. It's good to present it to a different audience and to have a discussion. I'm really looking forward to the discussion we're going to have now. As Lassen said, the presentation will go through several chapters. First, I'll just talk about the global economic outlook. I'll talk about the region then, dividing it between oil exporters and oil importers, since the economic challenges and the outlook is very different from an analytical perspective between these two regions. And then I'll say a few words about Lebanon. So, regarding the world economic outlook, the recovery continues in the world, but the remarkable feature of this recovery is that it is a two-speed recovery. Advanced economies are recovering relatively slowly from the crisis of 2008-2009 at a rate of about 2.5% this year, while emerging market economies are recovering much more strongly at about 6.5%. So, although the world economy will grow this year at 4.5%, there are the rapid growers. The rapid growth is coming from emerging markets, 6.5%, and slower growth is taking place in advanced economies, 2.5%. These are the three key numbers in terms of the world outlook. Now, the remarkable feature of this recovery is that the main fear that we had 6 months ago was the risk of a double dip recession, that following the crisis of 2008-2009, the world would fall back into a second recession after the initial stimulus and recovery had exhausted itself. Well, this double dip recession did not materialize, but new risks and new challenges are emerging. The first challenge is that the recovery, as I said, remains unbalanced. So some countries are growing fast, others are growing slowly. Now, what's the big deal about an unbalanced recovery? Well, there are at least three big deals in this. First, in advanced economies, unemployment remains high, fiscal problems remain acute, especially in the peripheral European Union, and so the policies there are much more challenging, and unemployment is expected to remain high for a while. So this set of the advanced economies face a difficult task of rekindling growth, raising potential output, going through structural reforms. The other set of countries, the emerging market economies, are going through a completely different set of policy challenges, which is to some extent to reduce the overheating risks that they are facing. Overheating due to large capital inflows, to strong growth, which could lead to inflation, which could lead to unbalanced growth inside. And their policy responses are to some extent very opposite to the advanced economies. The third big deal about the unbalanced recovery is what we were calling 6 months ago the currency wars, and these currency wars are to some extent continuing. One of the key mechanisms for the world economy to adjust is through the exchange rates. So advanced economies need to depreciate their exchange rate over time, and emerging economies need to appreciate their currencies. And this is long, difficult, and to some extent requires swift changes in policies. But this is the key adjustment mechanism that needs to take place in the future. And you will have seen in the media talking about the need for China to appreciate its currencies and the difficulties that this sort of policy entails. So this is the deal on the world about the unbalanced recovery. Another aspect, another new fear that has emerged relative to 6 months ago is the issue of the rising commodity prices. Oil and food prices have risen to unprecedented levels, or at least in the case of oil to the pre-crisis levels. And here in this chart on the left you have the oil prices. Sorry, I'm doing several things at the same time. So oil prices are rising, and this is due both to some extent to supply constraints, although OPEC has increased its supply of oil, but to a large extent to the recovery in demand for oil. And on the left-hand side, you see demand, total demand for oil recovering as a result of the recovery in China, emerging markets, and to some extent advanced economies. And this is putting a burden on policymakers. In the advanced economies, this rise in oil prices can be absorbed without too much impact on growth. But in emerging markets, where oil and food are large parts of the consumer basket, this raises the risks of inflation so reductions in real wages and hardships for the population. And this is a challenge that will be there for some time, although prices may start stabilizing and perhaps going down as supply catches up, especially in the case of food prices. Here this chart shows the rise in food prices, aggregate price indices for the world. Beverage, food and metals have been rising to above their pre-crisis levels in most cases. Of course, the rise in commodity prices benefits the exporters of those commodities, and some of them are in the region. But for most countries, it is an added burden on the population and policymakers. So let's turn to the MENA region. First, turning to oil exporters. Well, first a word of introduction on the MENA region. Of course, I have to start by saying that the region has been going and is going through a period of unprecedented change, which to some extent came as a surprise for everyone, including the IMF, of course. Although last October, Mrs. Ratna Sahai, Deputy Director of my department, was here in Beirut to talk about the challenge of high unemployment in the region and the problems that policymakers were facing to deal with this issue. We never imagined, of course, that this issue would to some extent be one of the root causes of these revolutions. Although the root causes of the uprising are political, to some extent the economic causes are intertwined. The region is also split between in terms of growth and prospects between the oil exporters and the oil importers. As the global economy is unbalanced, also the region is seeing an unbalanced outlook. The oil exporters are benefiting to some extent from the shocks I was talking about. Is benefiting from the rise in oil prices, and so these countries are expected to grow quite rapidly on the back of rising oil prices. On the other hand, the oil importers are expected to grow much more slowly, due to both the burden of these rising oil prices and the unrest in the region. So for the oil exporters, the rising oil prices is bringing a very large windfall in terms of revenues. The current account surpluses of the aggregate of the oil exporters of the region is expected to rise to $380 billion this year, $380 billion, which is a huge windfall that can then and is being used to raise public spending. The response in terms of public spending has been quite unprecedented. As an example, here on the far right of the chart, Saudi Arabia is raising government expenditure this year by over 30% relative to last year. So the windfall is being used for public spending, social spending, investment, also in response to the turmoil that these countries are facing. And despite the large rise in spending, fiscal balances are going to improve. This chart shows the rise in fiscal balances. This little part of the chart shows the overall balance. Despite a decline, a deterioration in the non-oil balances, fiscal balances, the fiscal balances are going to improve. So even though they are spending a lot, they are still having large surpluses, fiscal surpluses. Okay, this chart is very fancy, but is not very useful, so I'll skip it. And so overall, as I said, for the oil exporters, growth, and especially oil-related growth, is pulling the overall growth, while non-oil growth is projected to do okay, like last year, especially thanks to the fiscal stimulus. It's mainly non-oil growth that is pulling growth. And the oil exporters as a whole are expected to grow by about 5% this year. Now, one challenge, one thing to keep an eye on looking forward is relates to potential inflationary pressures, because as government spending expands, pressure may rise on domestic prices. These pressures are not yet present and not yet visible except in Iran, but this is a particular case due to the subsidy reform there. But this is an issue to watch for. Now, the regional economic outlook that we've distributed this year has a special chapter on the financial sector, and I'll just quickly summarize this chapter. The point is that in the MENA region, and particularly in the oil exporters, in the MENA region, the banking sector is relatively developed, but it is not as efficient and effective in promoting growth than in other regions. So these two charts show that in the MENA, the credit to GDP ratio, which is one way to look at financial depth, is relatively high relative to the rest of the world. So you see here the world average. Sorry, I'm pressing several buttons at the same time. So the world average is here, and the MENA average is here. So it's not too low, too far off, and it's even higher than on the average for the average of emerging and developing countries. So there is a strong and large banking sector in the GCC and in the MENA region in general. Of course, it varies for the different countries, but on aggregate, it's relatively large. But there are several issues. The first is that access to financial services is actually lower than in other regions, other parts of the world. Businesses receive less bank financing, loan concentration is relatively high, and the population has relatively low access to banking services. So the banking sector is large, but actually it's going to a small share of the population or a small share of enterprises and businesses. The second issue is that the banking sectors are usually less competitive than in other regions. There's weak credit information, so the credit bureaus are not very developed usually, and so this is an impediment to developing credit and private credit. There are stringent entry restrictions, so there's not much competition. State-owned banks are prevalent sometimes, and there are few non-bank financing alternatives, meaning stock markets, bond markets are not very developed. So with these two weaknesses, let's say, one can see, one can measure a quality gap in the financial, in the contribution of the financial sector to economic growth. So for a similar size of the financial sector, it is not contributing as much to growth as in other regions. So then policymakers need to work on this, and the chapter has a few suggestions and recommendations on how to address this. Looking forward for the oil exporters, the short-term challenge is inflation, as I mentioned, and the medium challenges remain the same as before. The challenge of diversifying the economy, strengthening the management of oil resources, developing the financial sector, these remain despite the windfalls and the good times brought about by high oil prices. Now, turning to oil importers, this is a diverse bunch of countries, as you see, which encompasses both Morocco, Mauritania, the Levant, and Afghanistan and Pakistan in our subdivision of the world. Well, you know, don't ask me why, but these are the oil importers for us. So before the crisis, they were growing at a steady pace, but not enough to absorb and to tackle the high unemployment. They have been subject to, many of them, to political turmoil, revolutions, and they are facing the higher commodity prices. Oil and food prices are higher. They have little space for policy responses. Their budgets are already tight, and they are facing difficult financing conditions with higher interest rates, higher risk premiums. And so the challenges are significant for this region. Okay, so this illustrates the cost of the rising food and oil prices. Many of these countries are dependent on tourism revenues, and these are being hit in the current context of political turmoil, especially in Tunisia and Egypt, of course, but in the broader region as well. Sovereign spreads, so the cost of financing abroad has risen following the political protests. These countries are also increasing fiscal spending, but not as much as the other countries. They are facing higher spending because many of these countries are subsidizing food and oil through various means, and they are also adding new spending to respond to social demands. But this is leading to very large deficits. This is the red dots showing the deficits, which are quite high for most of these countries. Now, nevertheless, in terms of growth, many of these countries will not or are projected not to slow down too much, except obviously for Egypt, Tunisia, which have have had the revolutions. In Egypt, Tunisia, growth is expected to be only about 1% this year. In Lebanon, growth only 2.5%, but this is for different reasons, and I'll talk about it later. Pakistan is still facing the aftermath of the floods, but in the rest of the region, growth is projected to be relatively sustained. Now, I have to say that this report was prepared a month ago, more than a month ago, in terms of the economic projections. I would say that this is rather on the optimistic or high side in terms of projections, especially in some countries close to us. Probably the impact will be stronger, both of the political unrest and the impact of food and oil price on growth. Inflation is still a problem and is still a challenge in these countries. Now, the chapter, the Rio has two specific chapters also which concern very much the oil importers. The challenge of responding to the higher food and oil prices, and the challenge of unemployment. And well, I guess the challenge here is also to understand this chart, but okay. In terms of unemployment, we already had talked about it in October in our previous report. Many of the countries in the region have much higher unemployment rates than in the rest of the world on average, both for total unemployment and youth unemployment. This is a problem related to slow growth, problems with labor markets, and the demographic youth bulge. Now, this time in this chapter, we propose a set of policy measures which are outlined very broadly. We divide them into quick wins that can respond to the short-term challenges, and then more medium-term job strategies. And some of these quick wins have to do with bringing forward infrastructure projects that are job-creating, providing incentives for small and medium enterprises, or scaling up or introducing training programs to respond to the skills mismatch. I'll go quickly over these. They are a bit more detailed in the report. The longer-term strategy to address unemployment is obviously a strategy of higher and more inclusive growth, which has to do with improving the business climate, improving trade, mobilizing the diaspora, and taking care of that not only the business environment is conducive to private sector growth, but that this business environment is really implemented and provides equal opportunities for all individuals and businesses to thrive and to develop and to create jobs. Enhancing skills formation has to do with, well, reviewing curricula to better respond to the needs of the private sector and of the government, revising government hiring practices. And then we have a few paragraphs on the idea or the principle of protecting the worker and not the job, which essentially means reducing improving protection of workers through, for example, unemployment protection, unemployment insurance, which is not very developed in the region, instead of protecting workers through systems of large severance payments, which are very costly for enterprises and discourage hiring in the first place. So this is one chapter that you'll find in the Rio with a few ideas or avenues for reform. The second chapter is it has to do with subsidies, and most countries have systems of subsidies whereby they subsidize goods. We propose, or as many others, to move towards systems that subsidize or protect people and in a targeted way. Now, the left-hand side chart tries to show that price subsidies, subsidizing goods such as fuel or bread, is a very crude and untargeted and in the end costly measure to help the poor. And the first bar, what this bar means up here is it means that out of the total cost of the subsidy, only 20% goes to the bottom 40% of the population, so let's say the poor and the lower middle class, while about 80% of the benefits of this measure go to the top 60% of the population, so the rich. So basically, and this is a cross-country study which is referenced here and in the report, basically these subsidies benefit the rich and benefit little the poor. Now they do benefit the poor. That's not to say that it's not helping, but it is a very untargeted measure that helps mostly the rich, to simplify things. And same findings to some extent for Jordan, the bread subsidies in Lebanon, or the bread subsidies in Egypt, which where only 35% of the benefits, of the cost of the measure, go to the bottom 40% of the population. So what to do about it? Well, the idea to subsidize people instead of goods means that one has to look at social protection in a broader context and develop other instruments for social protection. And these have, so price subsidies are only a subset of social protection. It has to do with safety nets, social assistance, cash transfers, programs such as which have had a tremendous success in Brazil or Mexico of cash transfers targeted to families and to the poor with very few conditions, or conditions of sending kids to school or going to health centers once or twice a year. Social insurance, unemployment insurance, old age pensions are another way to target the poor or the vulnerable. And of course other social policies such as, well, which has to do with providing services to the poor or the vulnerable, health, education, housing, labor policies. So this is sort of the direction, and then we talk about how to implement or move towards this sort of how to implement a reform strategy to move from subsidizing goods to subsidizing people, because of course obviously it's a long process. So to summarize, I mean, in concluding, we try in this report to start talking about a bit socially inclusive growth, or inclusive growth, which has several dimensions. Of course, a stable macroeconomic environment is critical. The two pillars, jobs and social protection, have to be addressed. And then governance issues, more transparency, more accountability, good governance, and access, fair, equal access to economic opportunities. These are all elements of an inclusive growth strategy. Let me say a few words on Lebanon, and then I'll be finished in 2 minutes, 5 maybe. For Lebanon, we published a few weeks ago a growth projection for this year, which was quite lower than most projections that were out until then. A projection of 2.5% this year. So after the 8-9% we were used to, our view is that we have already seen a significant slowdown in the first quarter, and that we see very few reasons for the situation to change in the short term in the second quarter. And even if the economy picks up in the second half of the year, overall this would yield a a projection of around 2.5, maybe more, maybe less percent. And this is the pattern here on this chart that we see. This is the coincident indicator of the Banque du Liban, but it closely tracks usually the GDP. And this is the basis for our projection. So essentially the political uncertainty and the regional uncertainty and turmoil are weighing on commercial activity, on tourism, on the real estate, which are the main drivers of the Lebanese economy. About 2/3 to 3/4 of the growth in Lebanon, not activity but growth, comes from commerce, trade, and construction. And so if these two drivers are no longer present, the economy should slow down. But we'll see, and we may be completely wrong. We identify, I like just to mention 3 challenges in the period ahead. First, on the fiscal side, slower growth will mean lower fiscal revenues, and so we project the deficit to rise up to more than 10% of GDP, whereas last year it was more or less around 7-8%. It's likely to rise. In addition, one factor that will contribute to lower revenue is the fact that excises on fuel have been reduced already, which will cost about 1% of GDP. If these excises on fuel are reduced again, this would cost another 1% of GDP, and so this will be a burden for public finances in terms of higher indebtedness. What I said last week at BDL was that 1% of GDP could probably usefully be used on more targeted measures to alleviate the burden on the poor and the vulnerable. And since we're talking about fuel prices, 1% of GDP could probably pay for a national public transportation system covering the whole of the country. So there may be alternative uses of 1% of GDP to reach social economic targets in the area of transportation. And this is something that is supported by what I've just said in the previous slides in terms of the studies on the impact and the poor targeting of these measures, of these subsidies of goods instead of people. On the monetary side, the challenge ahead is to maintain inflows into the country to finance the deficit, finance the private sector. And so the key variable here is the interest rate, and going forward there will have to be a permanent reassessment of whether interest rates are high enough in Lebanon to attract deposits and allow the financing of the fiscal deficit. This is something to keep an eye on and review at all times. Third challenge is the banking sector. The banking sector is critical to Lebanon's prosperity and growth, and we have seen in the recent past that it was vulnerable to anti-money laundering problems. There were weaknesses in this area. These seem to be addressed forcefully by the authorities, but this is clearly an area of vulnerability, and where going forward measures will have to be implemented. So thanks a lot for your attention. I'll look forward to the discussion.